Welcome back to News at Noon. I'm here with Scott Fanatico. And Scott, so there's been some talk about the economy not doing so great with like the recession and whatnot. What are some of your thoughts on that?
Well, you know, awareness of the economy for your audiences is a good thing. You know, it's similar probably to being aware of your health. You know, someone could want to measure his or her weight over a period of time, and by measuring that, they would have a sense of how healthy their future might be. You know, you could either be gaining weight, maintaining your weight, or losing weight. Would one of those be important, more than likely? Yeah,
definitely. I mean, personally, I would rather stay what I am.
Sure. And so, you know, the economy in the U.S. is, you know, very important to our well-being. So being aware of it is good. You know, it's our economy that provides us that well-being. And I say, unlike our weight, ideally in the United States economy, we wanted to see it gaining or growing. And that translates into transactions, you know, the buying and selling necessarily of goods. You know, and we have cash to spend, which is a good thing. But when we don't, what might we do if we want to buy something if we don't have cash?
We're going to put it on a credit card.
That's right. And a credit card is basically like a loan. Yes. And, you know, if you don't pay the balance off, then there's going to be an interest rate charge there. So big loans that we typically make are buying cars and buying homes. You know, and these loans are not necessarily expected to be paid off at the end of each month. So again, that interest rate is going to be so very important, you know. So guess who else makes big loans? You know, corporations and the United States government. So loans and interest rates are impactful on kind of really big decisions. You know, last week, so this idea of recessions, last week the headline was around what's referred to as the yield curve inverting. And stock market investors became fearful and started selling their shares, reducing the demand for price. So we saw the stock market go down about 5% at that point in time. You know, so why did investors who have a data point, you know, with a bit of information start selling stocks that so far this year had been up close to 20%? Which was a good year. You know, so there are things about yesterday, and then there's really about tomorrow. So that's kind of what the future is going to be. So when you think about companies, if you want to own these companies necessarily, it's likely that the price would go up in value. And so I bet anybody today, if they walked into their bank and they heard that their bank was paying them 5% on their checking account or their savings account, I bet the audience would say, I like that. That 5% interest, if I could walk into the bank and get it today, you'd see a lot of money going into the bank today.
Yeah.
But the reality is they're not paying that today necessarily, okay? So, and even a CFO of a large company would be saying, hey, if I've got $10 million to spend into manufacturing or building out a manufacturing facility, would I want to put that there? Would I put it into the bank? So, that going back to the idea that banks are not paying that, okay? So we had this what's referred to as a yield inversion. So historically, the difference between interest rates is this. The government's going to pay you. So if you loan them money for 90 days, they're going to pay you one interest rate. If you loan them money for 2 years, you'd expect a different interest rate. But if you were going to loan the United States government money for 10 years, you'd expect even a higher interest rate. And so what you do is when you connect those dots, you get a curve necessarily, all right? So the Federal Reserve is the Bank of the United States government, and what they've done recently is they simply started raising those short-term interest rates a little bit. And, you know, so the question becomes, are you going to save money or spend it? So back to this idea of this inverted yield curve. So what happened was not that interest rates on the short term have gone up to 5%. Thus, we'd put all our money into the bank, and CFOs would put their money into the bank, slowing down our economy, causing a recession. What's really happened is simply those 10-year bonds were no longer paying such a high interest rate. They started to pay even a lower rate. And so, again, when you connect those dots versus the normal curve being up, you would see the curve change. So the question then becomes, do we think we're going to have a recession? We're not so smart that we've been able to take the idea of our economy slowing down and recessions of the future happening. So more than likely, yes, we will see recessions. But this most recent, what they call yield curve inversion, is not going to be one that's so important in the short term. So I think we're okay.
All right.
Long-winded answer to your question.
Thank you, Scott.
Sure.
Appreciate it. Don't go anywhere. We'll have weather right after this.